Welcome to Biz Wire. I'm Joseph Nordstrom in Beijing. It's deja vu all over again. Well, almost anyway. Last June, short-term interest rates spiked as China's central bank initially refused to provide liquidity for a series of financial products with maturity mismatches, which were coming due at an inopportune time. And this past week has seen short-term rates double, but the People's Bank is more active this go-around in calming nerves in the markets. 6 months ago, the central bank largely stayed on the sidelines, taking a stand against runaway financing, especially in the off-balance sheet world of shadow banking. Last Friday, the central bank announced it injected the equivalent of nearly $50 billion into the financial system over the previous 3 days. This time also appears to be different, as there seems to be plenty of liquidity around, as the rise in interbank rates comes despite surging forex inflows, which have led to an unexpected rebound in lending. Also, as MarketWatch's Craig Stevens reports, banks are not short of deposits. Stevens says Bank of America Merrill Lynch reported fiscal deposits in the first 11 months this year reached 2 trillion yuan, or $320 billion, roughly double from a year earlier. Stevens says this suggests banks are hoarding cash and are reluctant to lend to each other. Author of Inside China's Shadow Banking, the Next Subprime Crisis, Zhou Zhang argues that China's market interest rate is now determined by shadow banking, not what the central bank or state banks are lending at. Zhang says when authorities allowed shadow banking to take off, they let the, quote, genie of higher rates out of the bottle. Because of this, depositors have become used to receiving higher rates on wealth management products, and borrowers were used to paying more for loans. Craig Stevens says the benign interpretation is that the shift to higher rates merely shows market forces at work, which will more efficiently allocate capital to viable businesses, though casualties could cause major disruptions. Economist Patrick Chovanec says the underlying issue is that China has been increasingly dependent on rampant credit expansion to finance its investment boom, and also to paper over losses from investments that have gone bad. Chovanec told Business Insider that means more and more credit is needed to generate less and less real output. He says the central bank is and has been aware for many years of the danger of rapid credit expansion, and that it's both fueling rising bad debt and also causing inflation, particularly in the property market. But Chovanec says when officials try to rein in the rate of credit expansion, they find banks, investment vehicles, and companies are overextended and can't meet their obligations. So the PBOC has little choice but to inject more cash into the system. Chovanec says every time the PBOC tries to reduce credit expansion, they risk provoking a crisis. So the credit crunch caused by maturity mismatches of wealth management products that come due at the end of each quarter ends up appeasing the central bank, who, not wanting a Lehman-style crisis, supplies the necessary liquidity. Formerly a professor at Tsinghua University in Beijing, Chovanec says the interbank lending market in China is a petri dish of risk that will require years of painful reforms to work out sufficiently. You're watching Biz Wire on the Blue Ocean Network, China's first and only privately owned English-language broadcast media. Our full episode can be seen on our website, BONTV/biz-wire. In just a second, we'll continue with more insight into the big picture of China's economy.